Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Good evening. Come to this question which was given to you as homework. Which is this question number? 8. You have noted the question? 10 lakh net profit, 12 lakh net profit, number of shares 10,000, 5,000, 3,000 shares issued, and there is a bonus issue also 1:1. If bonus is 1:1, it means the number of shares will double. Am I right? What is 1:1? One bonus share for one existing share. So if you have one share right now, it will become 2. So have you got the answer of the EPS of 2014-15? Those who have done, check. EPS of 2014-15, write down. Check. 10 lakh. This is your profit for first year. Then 10,000 share plus 5,000 into 3/12. These shares were issued after 9 months. Just see. 1/1/2015. So this were outstanding for 3 months into 3/12. Is it 11250 in the weighted average number of share? So 10 lakh divided by 11250 is the answer 88.89. Okay. Then you come to 2015-16 basic EPS. There is profit of 12 lakh, 15,000 share at the beginning. Have you taken 15,000 or 11,250? 15,000, because last year it was outstanding for 3 months. This year it is outstanding for full year. And they have issued 3,000 share for cash after 3 months. So that is outstanding for 9 months. So 3,000 into 9/12. So now we have 18,000 share in the books. Then bonus shares were issued. So I will add 18,000 without giving effect of time. So what is the answer here? Ji? 34.04. But because you have issued bonus share in this year, you have to restate the basic EPS of previous year. How many bonus shares were issued? 18,000. Now there are two answers possible for restated. Should I add 18,000 bonus share to previous year? Or should I also increase the previous year share in the ratio of 1:1? So the answer can be different. Earlier, the Institute of Chartered Accountant of India, New Delhi, had given one opinion long back that if you have issued 18,000 bonus share in this year, then you add 18,000 to the previous year also. So there is a problem here, because last year the number of share outstanding itself was 10,000 and 5,000, and that is also for only 3 months. So this is one answer. But the other answer, what you can do, you can also give the effect of bonus share proportionately in the previous year. Proportionately means if bonus share is in the ratio of 1:1, that means the number of share will get multiplied by 2 to get the total after bonus issue. The standard is not very clear about this calculation. This is as per ICAI opinion. But does ICAI opinion matter in IFRS? Question mark. So the other is proportionate. Take the weighted average number of share of previous year, weighted average number of ordinary share, and then you multiply by the adjustment factor for bonus. So if bonus share is in the ratio of 1:1, you multiply by 2, right? So that will give you total number of share. So 44.44. In the exam, you write both the answers. Now you tried this question 9 number also. Have you tried 9 number also? 9 was not homework. Oh. Now you'll try. Question number 9. ABC Limited has 10 lakh equity share outstanding on 1/1/16. Find out the weighted average number of shares. Have you checked this calculation part? Calculation part you have checked. ABC has 10,000 equity share outstanding on 1/1/16. Find out the weighted average number of equity share for the year 2016 for the purpose of calculating basic EPS in each of the following cases. So quickly answer. You have 10,000 share outstanding at the beginning. The company issued 2,000 equity share as bonus share on 1/4/16. So date is immaterial here. What will be the first answer? 12,000 share. Just add 2,000 share. Try the next one. Company issued 2,000 equity share for cash on 1/7/16 and 3,000 bonus share on 1/10/16. So this time, first you will have to calculate the weight for this 2,000 share. What is the year ending date? December. Because you are given opening balance on 1st January. Anybody wants to answer? What is the weighted average number of share here? Yes, the answer is 14,000. First answer right. 10,000 plus 2,000. Answer 2. 10,000 plus 3,000 bonus share and 2,000 into 6/12. 2,000 is outstanding for 6 months. So 14,000 shares. Okay. Dear student, now you solve one small question, number 10 in the book only. Find out the basic EPS from the following particulars. Basic EPS from following particulars. Share outstanding on 1/1/2004, 5 lakh. Issue of shares for cash on 1/7/2004, fully paid up, 1,70,000. Bonus share on 1/4/2004 is 1:2. Profit for the year 15 lakh. So what is the basic EPS in this problem? Anybody who has tried basic EPS? First you tell me what is the profit for the year. Profit for the year, come on. 15 lakh. Then you will calculate number of equity shares. Under that first beginning, how much is in the beginning number of equity share? 5 lakh. Okay. Then you add fresh issue. Fresh issue was made on 1/7/2004. So that is 1,70,000 and it is outstanding for 6 months. Year ending date is December. Why December? Because opening balance is given 1/1/2004. So is it 85,000? And dear student, one more bonus issue. When was bonus issue made? 1/4. Will the bonus share be issued on these 1,70,000 share? Bonus share will be issued only on the opening balance. So 1/2 into 5 lakh. Is it 2,50,000? So what is the total of the weighted average number of share? 8,35,000. So what is BEPS? Hanji? 1 point? Is it 1.80? Done. Try next one. Question number 11. Now this time you try yourself and give me the answer. The answer? You have got the answer. 2.2.78. Okay, let me also try. Let me also try. The question says profit for the year after tax is 21 lakh. Preference dividend 12%. Is it 1,80,000? So what is profit available to equity shareholder? 19,20,000. Number of equity shares in the beginning. Beginning is 6 lakh. Fresh issue of share at the end of third month, 1,20,000 into 9/12. Is it 90,000? So write in this blank line 6,90,000. So EPS will be 7. Okay, very good. Now you try one more. Done or doing? Done. Next one also. Do it fast. Is the answer over? No. The student is saying no. Okay, check the answer now. So you will guide me, okay? Net profit before tax is how much? 15 lakh. Less tax at the rate of 30%. Profit after tax 10 lakh 50,000. Preference dividend. Profit available. Now calculate the weighted average number of share. Number of share on 1st January 1 lakh. Issue of bonus share 50,000. Shares issued on 1st October 1st November 60,000 into 2 by 12 10,000. Buyback of share 12,000 into 1 by 12 1,000 negative. Very good, wonderful. So what is this total? Have you got 1,59,000? So answer 289. So 6.29. Done. Very good. Let us come to right shares. What are right shares? Some prior knowledge of right share is required. Right shares are shared issued to existing shareholders. Second, right shares are generally issued at a price lower than fair value. Why? Because you want to give some kind of benefit to your existing shareholders, some kind of reward to your existing shareholders. Right shares thus will include some bonus element also. Now, what is the meaning of bonus element? So, just for a general discussion, suppose the fair value is 40 rupees and the issue price is 20 rupees. So, company will have to issue 1 lakh shares. So, their number of share will increase by 1 lakh, but the resources will not increase. Resources will not increase to the extent of 1 lakh, because the share whose fair value is 40, you are issuing to them at 20 rupees. So there is some bonus element because of the discount effect here. And as we have seen in the earlier discussion, you have to make adjustment for the bonus element. You have to make adjustment for the bonus element so as to make the figures comparable. Therefore, the question arises, how to make adjustment for bonus element in right issue? How to make adjustment for bonus element in right issue? So we have to find out here also, like in bonus share we have found directly. In case of bonus share, if it is 1:1, I will multiply the previous shareholding by 2 to get the number of share including bonus effect. Am I right? But here I cannot do it directly. So I have to find out one adjustment factor. This was for bonus share I discussed earlier, not to be confused with this discussion. If bonus share is issued in the ratio of 1:1, you can multiply the previous year figure by 2 to give the effect of bonus element. But that cannot be applied in this case of right share. Not everything is free. In right share, not the entire shares are free. So I need to calculate a similar adjusting factor. I need to calculate a similar adjusting factor for the bonus element. So how do you calculate this adjustment factor? This adjustment factor will be the ratio of fair value before right issue and divide by what is called in this chapter X right price. X right price. X right price means what will be the market value of the share after the closure of right issue. Fair value is what is the market value before the right issue. Now the question is what will be the calculation of X right value. So X right value is the weighted average of X right value is the weighted average of fair value of shares prior to right issue plus amount received on right shares. So this gives me, numerator gives me total value. This is what I had before right issue. This is what I received as a result of right issue and divide by number of shares. Number of shares will be equal to before right issue plus right shares. So this formula is formula of VAR. Sir, what is VAR? Weighted average rate. This is weighted average rate because you have taken the total value divided by total quantity. Is called weighted average rate. And after getting this X right value, then calculate the adjustment factor. And then what will you do with this adjustment factor? This adjustment factor will be multiplied with the number of shares outstanding prior to right issue. All shares outstanding prior to right issue will be multiplied by the adjustment factor so that it will give the effect of bonus element in right issue. So now let us read further, and then with number I will be able to explain the logic also. So number of equity share to be used for calculating basic EPS for all period prior to right issue will be equal to number of equity shares outstanding prior to issue and into that adjustment factor. And then the question is, how do you get adjustment factor? Fair value per share immediately prior to exercise of right. Now this price you will take will be the last traded price. Last traded price up to which the holder will buy the share and get the right also. So this I am going to simplify by calling it come right price. Come right price. Last traded come right price. Last traded. Suppose the right issue closes on 31st of October. Anybody buying share up to 31st October will get the right also. So if the market closes at 3:30, we'll take the last traded price. And then I will divide by theoretical X right fair value per share. This is theoretical because this may not be based on actual price in the market on the next day. This is based on our formula. Why they have added the word this theoretical? Because it is based on a formula. Share market does not follow formula. So therefore take fair value of share prior to right, amount received from exercise of right divided by total number of shares. And then after getting X right price, use it for calculating adjustment factor. After calculating adjustment factor, multiply it by the number of share outstanding prior to right issue. Do not multiply by the number of share after the right issue, because right issue already includes, fill in the blanks. Right issue already includes the total number of shares, which includes the shares issued with fair value, which also includes shares issued without fair value, free of cost also, bonus element. Okay. So therefore you have to only make adjustment for share outstanding prior to right issue. Now solve this example for understanding in the notebook. R Limited has, answer is not printed. So those who don't want to write will also have to write. R Limited has 1 lakh equity shares outstanding in the beginning of the year. After 3 months, it issued right share in the ratio of 1:5 at rupees 20 per share. So this is our year, and after 3 months, right issue was made. You have at the beginning 1 lakh share. What is the right issue? 1:5. 1:5 means for one right share for 5 existing share. So 20,000 right share will be issued. The fair value of this share before the right issue was 30 rupees, and the net profit is 18 lakh for the previous year, current year, 14 lakh for previous year. Find the basic and EPS for current year, and you restate the basic EPS for previous year. Restate the basic EPS means what? We have to recalculate the basic EPS of previous year. Why? Because this year there are some issue of share which has bonus element. If I do not restate, then the previous year and this year may not be comparable. Okay. Now 3 steps will be involved first. First you will find out what would be X right price. What would be X right price? So write down the answer along with me. X right price. X right price means value of share, fair value before right issue. 1 lakh share was outstanding before right issue, yes. And what was the market price? 30. How many right shares are issued? 20,000. What is the right issue price? 20. Divide by 1 lakh and plus 20,000. So how much it comes to? Sure, 28.33. This means the value of this share after right issue will be 28.33. And its market price is 30 rupees. So there is a bonus element here. So now write down adjustment factor. Adjustment factor will be 30 divided by 28.33. Answer 1.0588. Can we write 1.06? 1.06. And 3 write down basic EPS current year. Now this calculation is little complicated, but once you understand it, it's easy. So for that I have to first write down the net profit for the year, which is 18 lakh. And now you see, first 3 months was the period when there was no right issue. So I have to multiply 1 lakh into adjustment factor 1.06 and into 3 by 12. And then plus, now how many shares we have? 1 lakh 20,000. After that right issue, and this you multiply by 9 by 12. This you multiply by 9 by 12. Now see, for understanding why this second part we are not multiplying by 1.06. Here we are taking 1,20,000. This 20,000 share includes already bonus element. Because I am issuing 20,000 share. Some of the shares are bonus. It already includes, but here I have to make adjustment so that bonus share is covered in all the period. So what is the final answer for this? Anybody who has any idea? Final answer? Final answer. Final answer. 80 lakh divided by this factor 15 rupees. $15.45. Okay, now write one more answer. Restated basic EPS last year, previous year. Now this I will take 14 lakh. What was the shares outstanding? 1 lakh, and this you multiplied by the adjustment factor. This you multiplied by that adjustment factor. So how much it comes to? Final answer. 13.21. 13.21. Even though this is quite understandable that shares were issued below the fair value and hence there is a bonus element, but then the question arises why we need to multiply the previous year by adjustment factor. So as I said, if you don't multiply, don't give the effect of bonus element, the data may not be comparable. So write down one small example to demonstrate a very different way of understanding the logic, that why we need to adjust for bonus element in right issue. So let us understand bonus element in right issue. Write down bonus element in right issue. Then you write down this data, year 2016. Now this question, this is nothing to do with the previous problem. It is just a logic of understanding the logic of why that adjustment is done in a different way. Try to understand. So write down, dear student, year 2016, net worth is 30 lakh. Net worth is 30 lakh. Number of equity shares 1,50,000. PAT is 3 lakh. PAT is 3 lakh. Return on net worth. Return on net worth. Now this is a ratio which one has to know right from financial management subject in graduation course. You have earned 3 lakh on a net worth of 30 lakh. So your performance is you can earn 10% on your net worth or your equity. And what will be the EPS? 3 lakh. Divide by 1,50,000, that is 2. यहाँ तक ठीक है? Up to this is understandable? Up to this is understandable. Okay. Next year what happened? See. Write down next year. Year 2017. Next year write down year 2017. This company came up with right issue. Right issue. And what was the right issue? 1,50,000 shares. Means 1:1 ratio. At rupees 10 at the beginning of the year. 1,50,000 share was issued at the beginning of the year. So can I say the right issue is in the ratio of 1:1? What is the funds raised from right issue? 1,50,000 into 10, 15 lakh. Is it right? 15 lakh. So therefore the net worth or the capital employed will become now 30 lakh plus 15 lakh. Can I say that? Now you have 45 lakh rupees to do business and your productive capacity is 10%. That means you can earn 10% on your capital employed. So next line, write down number of equity shares. Number of equity shares 1,50,000 plus 1,50,000, 3 lakh. Profit after tax. Profit after tax is 10% of 45 lakh. Is 4,50,000. EPS will be 4,50,000 divided by 3 lakh, 1.5. Anything wrong in this calculation? Nothing is wrong in this calculation. Everything is done properly. Okay. Now you are the shareholder. You will compare EPS. 2 rupees last year. 1.5 this year. So will you be angry or happy? Angry. Angry. No effect. If I see last year EPS is 2 rupees, this year EPS is 1.5, I'll get angry. I'll tell the management, what are you doing? You are destroying our wealth. We are giving you more capital and you are destroying our wealth. You've reduced the EPS, which means these two numbers are not comparable. Something is wrong in the comparison process, right? What is wrong? This year we have issued 1,50,000 share at 10 rupees. If I look at the value of this share, net worth is 30 lakh, number of equity share are 1,50,000. Taking net worth for fair value, we can say that the fair value of the share is 20 rupees. Assume net worth as fair value. And 20 rupees share you are issuing at 10 rupees. So there is some bonus element. And therefore the 2 years are not comparable unless we make adjustment for bonus element. So what is fair value before right issue? Fair value 20 rupees. Fair value after right issue 45 lakh is the net worth and 3 lakh is the share. So roughly how much is the fair value after right issue? X right price 15. So what is the adjustment factor? 20 by 15. 20 before right issue, 15 after right issue. Multiply 20 by 15 into the previous year number of share. Make adjustment to the previous year number of share. 20 by 15 into 1,50,000. Now you'll get 2 lakh share. Now you recalculate the EPS of previous year. So this will also become 1.50. Is it right? So write down calculation of adjustment factor and restated EPS of 2016. Calculation of adjustment factor and restated EPS of 2016. First write down particulars calculation amount. Fair value before right issue. Fair value before right issue. ₹30 lakh divided by 1,50,000. 20. Fair value after right issue. 45 lakh divided by 3 lakh. Rupees 15. Adjustment factor 20 by 15. Adjustment factor 20 by 15. Then write down adjusted number of shares for 2016, 1,50,000 into 20 by 15. That comes to 2 lakh. And now write down restated EPS. Restated EPS will be 3 lakh upon 2 lakh. Is it 1.50? Happy? Yes, now you'll be happy. Performance is maintained. Without this, there can be a confusion in the minds of the investors, as you have seen just now. So therefore, the bonus element in right issue is to be adjusted for period prior to right issue. Now, a similar adjustment will be done for share split and consolidation. What do you mean by share split? Share split means shares of larger denomination is divided into shares of smaller denomination. So example of share split could be 10,000 shares of 10 converted into 20,000 shares of 5 rupees. Yes or no? And what is the example of consolidation? 10,000 share of 10 rupees is consolidated into 5,000 shares of 20. Now these are only cosmetic changes. They do not increase the resources of the company. So like bonus share, you will give the effect of share split and consolidation. Assume these changes have taken place since the beginning of the year. And if you are presenting the previous year figures also, then make adjustment to previous year EPS and diluted EPS also. Correct? Why? Same reason. Otherwise it will not be comparable. Okay. Next line. Share split and consolidation does not affect the earning but changes the number of shares. Number of shares to be calculated after the split or consolidation, assuming as though the event of share split or consolidation had occurred at the beginning of the earliest reporting period. The meaning of this line, beginning of earliest reporting period, is if you are preparing a comparative EPS also, even there you have to give the same effect. Okay. In all these years, figures of prior year will also be adjusted appropriately. Now there is one adjustment they have mentioned in the standard, which is little difficult for you to understand at the first reading. However, when the overall effect is a share repurchase at fair value, when the overall effect is a share repurchase at fair value, the reduction in the number of ordinary share outstanding is the result of corresponding reduction in resources. Now sometimes what companies do, and this example is again an example for substance over form. A company announces consolidation, for example. Company announces consolidation, so number of share will reduce. And company also announces a huge special dividend. Special dividend means not just normal dividend, 10%, 20%, 30%. The special dividend will be something like 2000% dividend, 3000% dividend, 1000% dividend. When you give special dividend, your resources are reduced. your resources are reduced. Abnormal high dividend will reduce your resources significantly, and it is also along with share consolidation. So then the standard says reduction in number of share will be treated as if it is a buyback of share. Reduction in number of share because of share consolidation and along with special dividend will be deemed to be not actual buyback. It will be treated like it is a buyback of share because your shares got reduced and your resources are also reduced. So then in that case we have to make adjustment like this. The weighted average number of ordinary share outstanding for the period in which the combined transaction takes place. Combined transaction means share consolidation plus special dividend. The weighted average number of ordinary share outstanding for the period in which combined transaction takes place is adjusted for the reduction in the number of ordinary shares from the date the special dividend is recognized. So this would be treated like a buyback of share. Okay, because number of share got reduced and resources also got reduced. So when there is a buyback, do we make adjustment to previous year figure? No. In this case also, since it is similar to buyback, even though there is a consolidation of share, the previous year data need not be, complete the line, need not be restated. Very good. Now, first I need to give you an example on this. There is a question below, and this is a very different question. You may not have done it earlier in other standards. M Limited consolidated 10 shares into 1 share. Just make a small change in the date on 1/4/15. 1/4/15. 10 share were consolidated into 1 share. So what will happen to number of share? Number of share will fall. Number of share will fall substantially. Okay. With special dividend at the rate of rupees 200 per share. As on 1/4/15, the average market price per share based on simple average closing price over immediately preceding 3 months was rupees 20 per share. The relevant information relating to basic EPS computation is as follows. Now they have given you data of previous year and current year. 14/15 previous year, 15/16 current year. Number of shares, earlier it was 500, and why it has suddenly reduced to 50? 10 share were consolidated into 1 share, so 50. And reduction in the share by consolidation is 450. Special dividend per share is 200 rupees. Net profit for the year 800 and 900. The average share price, again you write it 1/4/15, average share price is 20 rupees. Find out the basic and diluted EPS. Now there is no need to ask diluted EPS here. Okay. So in fact you will write same answer for both. So in this problem, normally what we would have done, normally we would have simply taken the profit divided by number of share, profit divided by number of share, and then we would have restated the previous year data also. But in this case, it is similar to buyback effect. Can you see that? You have reduced the number of share from 500 to 50, and you have paid a dividend of 200 rupees per share. 200 rupees per share when the market price is 20 rupees per share. So if I divide 200 by 10, 10 shares were consolidated into 1 share. Am I right? So that means per share, how much you are paying? 20 rupees. Yes or no? 200 per share. 10 share were consolidated into one. So therefore we will assume it is 20 rupees per share paid as dividend. This 200 will be with respect to one stock. With respect to 10 share, it is 20, and which is almost equivalent to the market value of the share. So what you are actually doing, you are buying back the shares at roughly the average price of the shares. So this would be treated more like a buyback of share, and the reduction will be not given effect for comparison purpose in the previous period. So previous year data we will not restate in this problem. Write down, dear student, in the given case, the special dividend of rupees 200, the special dividend of rupees 200 is comparable to the pre-consolidation market price of rupees 20, is comparable to the, in the given case, the special dividend of rupees 200 per share on pre-consolidation holding is rupees 20 is comparable to pre-consolidation market price of rupees 20. So it is like paying 20 rupees per share. Therefore consolidation is a kind of buyback of share at fair value. It is effectively a case of share buyback. It is effectively a case of share buyback. Accordingly, the retrospective restatement of EPS, required as per IAS 33 would not apply. Required as per IAS 33 would not apply, because in this case there is not just simple change in number of share, there is a corresponding change in resources also. Okay, your ability to do the business will go down in this year because of this special dividend of 200 rupees per share. When are we going to make retrospective adjustment for previous year also? When only there is a cosmetic change without any change in resources. But here we will say there is a change in resource, so the reduction in share will be attributable to change in resource. Now we will write calculation of basic and diluted EPS. There is no potential ordinary share in this example, so basic and diluted EPS will remain the same. Don't worry. Write down. Right hand side, two columns. First column in the answer, normally we should try to write current year, and second column we should try to write previous year. Okay, even though in the question it is given in opposite sequence, 31st March 16, 31st March 15. Then you write down profit for the year after tax, 900 and 800. Then write down shares numbers in million. Ordinary share outstanding First you write down 500 less reduction in shares. See the wording, less reduction in share arising out of consolidation in the nature of share buyback. Reduction in share arising out of consolidation in the nature of share buyback. $450. Now write down therefore ordinary share outstanding. Therefore ordinary share outstanding 50 and 500. 50 and 500. Ordinary share outstanding 50 and 500. Earning per share in bracket basic and diluted 900 divided by 50, 18 rupees. 800 divided by 1.6, 800 divided by 500, 1.60. Do we need to restate the previous year figure also? No, because this consolidation is in the nature of share buyback. Okay. Now we'll come to one more complication. Contingently issuable shares. What is contingently issuable share? Shares which will be issued on happening of a event. We have seen in our standard IFRS to share based payment, the employee will get share if he achieves some performance target. So company says if the company earns 100 crore rupees profit, you will get 1000 share. So that is a contingently issuable share. So how do you treat contingently issuable share in basic and diluted EPS calculations? Okay. So first we will see basic EPS today. Our topic right now is basic EPS. Immediately after this, diluted EPS. Contingently issuable share will be considered for basic EPS only from the date of fulfillment of condition. Contingent issuable share will be included in calculating the basic EPS only after the fulfillment of whatever that condition is, that contingency is. Okay, this will be treated as outstanding and will be included in basic EPS the moment the contingency is satisfied. And what about the time period for which you have to include it? This is included from the beginning of the period or from the date of contingent share agreement if it is entered into during the period. So if the problem says company and the employee entered into a contingent share agreement from 1st July and suppose my year ending date is 31st March. So if the date of agreement is other than the opening date, then the student will take from the date of agreement till the date the contingency is satisfied for the purpose of basic EPS calculation. If the date of agreement is not there and the contingency gets satisfied on 31st March, then we will assume the shares were outstanding from the beginning of the year. So these are included from the beginning of the period or from the date of contingency share agreement if the contingency share agreement was entered at a later date during the period. If the condition is not satisfied by the end of the period, then do not include it in the calculation of basic EPS. What about diluted EPS? That I will tell you below. But for the timing, only basic. Solve question number 16. And then this question will help you to understand one, what is contingently issuable share. Second, how to calculate basic EPS when there are contingently issuable share outstanding and the condition gets satisfied by the end of the year. Solve. As on 1/4/2015, X Limited offers 10 share-based payment to each of the employees. If the PAT for the year 15-16 exceeds rupees 5,000 crore. So this question gives you the date of agreement also as 1/4/15. And the condition is that if the profit of this year is more than 5,000 crore, 10 share-based payment to each of the employee. How many employees they have not mentioned so far? Shares will be issued on 31st December 2016. That is not a necessary condition for calculation of basic EPS. Once the condition is satisfied, you will include this share in basic EPS even though the shares will be issued at a later date. Now on 31st March 16, PAT works out to be rupees 5,100 crore and the share based payment works out to be 50 lakh shares. Now they have calculated 50 lakh share. Okay. Outstanding share on 31st March 16 was 100 crore. What is this 100 crore? This is your number of share in the balance sheet. This 50 lakh share is what you have promised to issue to the employees if the conditions get satisfied. Now question is, what is basic EPS? Try. Almost over. Profit is given 5100. You have to only decide, should I divide by 100 crore share or should I divide by 100 crore plus 50 lakh share? Is the condition satisfied on 31st March 16? Bolo yes. Say yes. Yes, louder. Yes. If the condition is satisfied, that means it will be included in the basic EPS from the beginning of the period or the date of entering into agreement. Both are 1/4/2015 only. So it will be included in basic EPS if the condition is satisfied from 1/4/15 to 31st March 16, 12 months. So since it is a 12 months, there is no weightage required for the contingently issuable share. If the agreement date was given, suppose 1st July, then this 50 lakh share would be multiplied by 9/12. 3-line answer, basic EPS. Write it neatly, properly in the notebook with reference of question number, page number. Net profit, right hand side rupees in crore, 5100. Weighted average number of share. Weighted average number of shares 100 plus 0.50, not 100 plus 50. 100 is crore and 50 is lakh. 100.50. Therefore, basic EPS is 50.75. So this paragraph ends our discussion on basic EPS. Now we will come to diluted EPS part 2. 50% job is done. For calculating diluted EPS, first we need to revise one concept called potential ordinary shares. So these are those contracts or financial instrument that entitle or may entitle its holder to ordinary shares. So those who are holding this instrument, they will get or they may get ordinary shares. But for the entity, these are the shares which have the potential to become the ordinary shares in future. Example, convertible preference share, convertible debenture, share warrants, options, put option, call option, forward, future, even they can also be considered in the potential shares. Contingently issuable share also. Why do we need to bring potential share in our calculation? Sometimes it may happen that if these potential shares are converted into actual share, if instead of potential share, if they are treated as actual share for the year, your earning per share can fall. Had this not been potential share, had this been actual share, this year your EPS would have been lower. Positive EPS and negative EPS would have been higher, which means the investor would have earned less dividend in this year. Okay, would have got less profit, and therefore they need to be informed. They need to be informed in advance that dear student, so not student, dear shareholder, that is my dialogue, dear student, dear shareholder, please be aware that the EPS may be reduced in future. Same EPS may not continue because there are many potential ordinary shares. But sometimes there can be a reverse effect also, anti-dilutive. After considering the potential shares, your EPS may increase or loss per share may decrease. Should we inform that also to the investor? No. But we'll only disclose the type of anti-dilutive potential share. What will disclose? Whichever instruments are anti-dilutive, only their name will be disclosed. But the amount of anti-dilutive EPS will not be disclosed. So that is the difference between dilutive and anti-dilutive. Dilutive EPS is disclosed. Anti-dilutive EPS is not disclosed. Only the anti-dilutive potential shares are disclosed. Why diluted EPS is disclosed? This will affect the interest of shareholder and the decision of the prospective investors. See, if the EPS falls, what are the side effects of that? Dividend earning of the shareholders will fall. Stake of the shareholder will fall in the company. Market price may fall. Market price may fall means your wealth may fall. So you will become poorer than what you were earlier just because there are potential share in the company's books. Okay. So therefore, after knowing this information, you can take your decision. Now, how do we give the effect of potential share in our calculation? So first of all, I should make it again clear. Calculation of diluted EPS is a notional calculation, is a hypothetical calculation. What does that mean? It means we are assuming if potential shares were converted into actual share, then what would have been the EPS? Okay. So make two adjustments, one in the numerator and one in the denominator. How do you make adjustment in the numerator? So first I will take the same profit which I have used for basic EPS calculation. Start from there. Do not calculate diluted EPS first. First calculate basic EPS so that that profit figure is ready. And make adjustment for any increase or decrease in profit due to potential share. Suppose convertible debentures were not there. What will happen? Interest would not have been paid. If interest would not have been paid, my profit would have been higher. Add back interest. Whatever interest you have debited in the profit and loss, add back. Then there is a disadvantage of not paying interest. You will not get the tax shield on interest. So that you reduce if the tax rate is given in the question. Then one more example I'll give you. Suppose there are convertible preference share. If you would not have paid preference dividend, the earning available to shareholder would have been higher. So add preference dividend. And in some problems, you will also have one more saving, tax on preference dividend. And then I have written one more thing at the end, plus minus any other change in income or expense that can be attributed to and result from their conversion. Now, what do you mean by that? Suppose, for example, the salary of the employee is paid on the basis of profit, correct? So, if the profit will change, the salary payable will also change. So, therefore, I may have to reduce the profit because of incremental salary, additional salary. If you don't pay interest, profit will increase. If profit will increase, you will pay more salary. So, plus minus any other income or expense. One example also I have written, just see. For example, the reduction of interest expense relating to potential ordinary shares and the resulting increase in profit may lead to increase in expense relating to a non-discretionary profit sharing plan. Okay. But in case if the question is silent, you are a student, you will only adjust what is given. And what about the denominator? Will the denominator also increase? Yes, that is why we are doing this calculation. So first I will write weighted average number of ordinary share. WANOOS, weighted average number of ordinary share, and then you have to write down shares to be issued to potential ordinary shares. Okay. So normally this calculation may be easy, but sometimes this calculation may be difficult when some consideration will also be paid by the potential equity holder. So in that case, this will become shares issued without consideration, like in case of ESOP, shares issued without consideration. In case of convertible debenture, this figure is directly given to you. 2 lakh debenture will be converted into 4 lakh share, right? 4 lakh. But in case of ESOP, they will say 1 lakh ESOP will be issued, but not free of cost, at 30 rupees per share when market price is 60 rupees per share. Then I will not write 1 lakh. I will write out of this 1 lakh, how many of them are free of cost. So that is called shares issued without, this is without consideration. Okay. But this is not as simple as it seems on the screen. Lot of things we have to adjust. So now we'll take one by one. So weighted average number of ordinary equity share. The number of the aggregate of basic weighted average number of ordinary share and the weighted number of additional ordinary share which would have been outstanding assuming conversion of all potential ordinary shares. Some more complications are like this. Suppose the year is like this. First, let us say write January and let us write 31st December. Some potential shares were outstanding here. Okay. And either they got converted or they got lapsed, cancelled on 30th June. Then it will be covered in the calculation of diluted EPS from the beginning of the year till 30th June. From beginning till 30th June. Another possibility can be on 1st April, convertible debentures were issued. Year ending date is 31st December. Then we will consider it for a period of 9 months in the calculation of diluted EPS. Question the student will ask is, should we apply the weightage to potential share also? If nothing is given, then assume they were outstanding from the beginning. If specifically they have been given that convertible debenture were issued on 1/4/2020 and year ending date is 31st December, you will have to consider them only for 9 months. If they were outstanding at the beginning and they got converted, lapsed, etc., somewhere during the year, then from the beginning till that point, it will be used for calculation of diluted EPS. The dilutive effect of potential ordinary share issued by subsidiary in the first case,
Shares are as on beginning of the year.
outstanding at the beginning of the year, potential share.
And they are converted somewhere during the year.
Somewhere during the year.
Then why we have to include them in diluted? Because anyways they are going to get included.
Next year when you compute the basic EPS, then they are considered for the full year. This year this resources was used to generate the profit. Since the resources were used to generate the profit, the effect of that should be shown in the EPS calculation. Resources were being used. This is money that you are using. So since the resources were being used, the effect of that should also go in the calculation of EPS. Otherwise, you will be only using the resources, making profit, but not considering this in the EPS calculation. It is okay.
Considering in basic EPS.
In diluted also. This I am talking about diluted.
We show diluted EPS.
From 30th June to 31st December, it will be calculated in basic EPS. If you consider in basic calculation, it is always getting calculated in diluted also. So this portion will automatically come in both basic and diluted. Basic means it has already got included in diluted also. Is it right? Plus this also. Your question is good. We have used the resources in this period, which have created profit for us. Okay, now you come to one complicated calculation today. The dilutive effect of potential ordinary share issued by subsidiary, joint venture or associate that may be converted into parent's ordinary share or ordinary share of subsidiary, joint venture or associate on the basic EPS of the reporting entity should also be considered. This paragraph is also important. If the subsidiary, associate or joint venture have issued some kind of potential share which may either be settled in the form of parent's ordinary share, that we have seen in chapter IFRS 2, will that also be considered in the calculation of diluted EPS? Yes. Sometimes the subsidiary, associate, joint venture may issue potential share which will be converted into their share only. Which will be converted into their share. Simple example, a subsidiary has issued ESOP to its employee and this ESOP will be settled by subsidiary's own share. Will this be considered in the calculation of diluted EPS in CFS of parent company? The answer is yes. No. Why? That's a good question. Why? Subsidiary has issued ESOP to its employee. So in future what will happen? Number of shares of subsidiary will go up. So right now parent is holding 80% share in subsidiary. But suppose because of this ESOP, parent share goes down to 78% share in subsidiary. So my calculation at present, which is based on 80%, in future, because the subsidiary will issue share to outsider, parent share in the profit of subsidiary will decrease. So, if parent share in profit of subsidiary will decrease, the EPS will fall, because consolidated EPS, which I am going to take one example immediately, you will take parent's profit plus share in subsidiary profit, and then you divide by parent's share. But this will decrease if the subsidiary has outstanding potential share. Same logic applies for joint venture and associate also, because we also add the proportionate share in the profit of associate and joint venture. So if they have outstanding potential share, my share in the profit in future will go down, and therefore my EPS may fall. So now I have created one question for you. Write down. Some portion is written, some portion you have to write. Question is also not fully written. First we'll complete this problem, then you can enjoy the break. As on 31st March 2016, P Limited has following investment. It's written. As on 31st March 16, P Limited has following investment. Subsidiary company shareholding percentage is 60%. Calculate basic and diluted in both SFS, means separate financial statement, and CFS, means consolidated financial statement of P. Other details: P, S, PAT, 130, 30, number of share, right? This you have to write, this table. P Limited, S Limited, PAT 130, 30, number of equity share 5, 2, potential equity share. Potential equity share parent has also issued, so that will be required in SFS also. Point 20, separate financial statement, diluted EPS. And subsidiaries potential equity share will be required for CFS purpose. What is P Limited shareholding? 60% of 2. So number of share held 1.2 crore. Calculate. Basic EPS in separate financial statement. Write down calculation of basic and diluted EPS in separate financial statement. Calculation of basic and diluted EPS in separate financial statement. Right hand side 3 columns: amount, number of share, EPS. Amount, number of share, EPS. Point number A, as per separate financial statement, as per SFS, as per SFS, 130, that is given. 5, number of share. Calculate 26 bracket basic EPS. Then how do you compute diluted EPS? Because of this ESOP, by what amount my profit will get affected, or will it not get affected? It won't be affected because there is no interest or dividend. Only my number of share will increase by 0.20. So point number B, write down adjustment for ESOP. Point number B, adjustment for ESOP. Impact on the profit is 0. Impact on the profit is 0. Impact on number of share is 0.20. So my revised calculation will be: profit will remain 130, number of share will be 5.20, EPS will be 25. that is called diluted. Okay. Now we write down calculation of basic EPS in CFS. Calculation of basic EPS in CFS. So what in CFS we do? We take the profit of the parent company 130. We add the share in the post acquisition profit of subsidiary. Add share in the post acquisition profit of subsidiary, which is 18 in bracket 30 into 60%. 30 into 60%. And point number C, total profit in CFS. $138. Total profit in CFS 138. Number of shares. Haji? Is it 148? Oh, computer G is wrong. 148. So what is number of shares? Number of shares will be 5. Don't add share of subsidiary. When we prepare CFS, the number of share we consider only parent company. Good question you asked. Should we add subsidiary also? No. So therefore basic EPS you calculate properly. What will be the answer? 29.6. Okay. Basic EPS 29.6. Now visualize how will your diluted EPS be calculated in CFS. Diluted EPS. Now I'll just take you back to the previous calculation. See the diluted EPS in SFS. Okay, 130, 5.20, 25. And then basic EPS in CFS is total profit is 148. Number of share you have considered 5. Now, who has issued the potential equity share? Subsidiary and parent both. Parent will be considered in the number. Subsidiary will be used for adjusting the profit figure. Subsidiary will be used for adjusting the profit figure. So tell me, if subsidiary issues tomorrow, how many share was given? Subsidiary potential 10,000. 0.10. So subsidiary share capital, which is right now 2, will become 2.1. Is right? 2 will become 2.1. Am I right? First understand. And parent will still hold 1.2. So parent share will become 1.2 divided by 2.10. How much is 1.2 divided by 2.10? Multiplied by profit of subsidiary 30. Multiplied by 30. Now my stake in the subsidiary is little lower than 60. So my profit will reduce. My share in profit will reduce. Okay. So you are not answering. What will be the share in the profit of subsidiary after the subsidiary's potential share are considered? 57.14. Very good. 57.14. No, something is wrong. Your share will be only, earlier it was 60% of 30. Now 57.14% of 30.
17 point. अच्छा, you are asking
Profit 17.14. 17.14. Wonderful, that is right. Earlier we considered 18, but now if I consider the potential share, our share will be 17.14. Agreed? So 17.14 means our share in the profit of the subsidiary will fall by 0.86. Will fall by 0.86. So anyway you present, either you can directly write 130 plus your new percentage that you have calculated into 30, or from the total already calculated, deduct the reduction in the profit. So write down point number B, dilutive effect arising out of issuance of stock option by S Limited, arising out of stock option by S Limited on parent's share of profit, on parent's share of profit. So this is what we calculated earlier, 60% into 30, and the reduction in the profit will be 1.20 divided by 2.10 into 30. So the net effect is 0.86. So now you write down total after deducting that. Is it 147.14? 147.14. And then you write down number of shares. Only parent company 5.20. Is it right? And therefore diluted EPS. How much is therefore diluted EPS? 28.30. 28.30. So this is a small example on how do you calculate the diluted EPS if the subsidiary has also issued potential share. Similar calculation will be done for associate and joint venture also. They can even ask a question where all subsidiary, associate, joint venture, parent, everybody has issued potential share. Okay. So now we will take a break.